For those of you who don't know who I am, I've been trading for quite a while. If you think about it, now starting from the 90s, it is long term, the way you'd be thinking about long term retirement. But I've been trading since the late 1990s internet boom and bust. And I have busted early on and then boomed. And that's where we are now. Ran it up, booed two accounts before I hit that light bulb moment for swing trading. Mentored Kanal, who is the founder and CEO of Bulls on Wall Street, back in the mid 2000s, traded through all the different kind of markets, which really is helpful when you're thinking about long term. So traded the 2000 and 2008 bear markets and other mini bear markets we're through recently, and actually the March 2020, which was a super quick bear market, was not mini. It was a pretty big one. Went full-time trading in 2012. 2014, Kanal asked me to run the swing trade service of Bulls on Wall Street, and that's what I've been doing ever since. And if you want to know more about me, there's a chat with traders interview. Just you can get the link here, or just Google. Actually, I can post these things in the chat. Here's the link to the chat with traders interview. If you want to know a little more about me, my story, my background. There's a couple other interviews too here with Desire to Trade. You can check those out as well. And once you've been to one of these things, you're part of the Bulls family. So email me, contact me anytime, and I'll get back to you. SinghJD1@AOL.com. You can follow me on Instagram and Twitter as well. I post almost every day, stories, charts, and all that good kind of stuff. So check me out there too. And again, any questions at all, just shoot me a message. And if you guys have questions as we're going through this, post your messages in the chat. Josh is in here, and I think he just posted, might have just posted something in here. And he'll answer any questions that I don't get to. Okay, Anil has a question, not really related to retirement, but I guess it could be. How do you narrow down individual tickers to put on your focus list? I have a whole process for that. There are a couple of scans I use, but mostly I'm doing industry analysis. And we'll actually talk about industries. Even we focus on it on swing. We'll even talk about it in our retirement class as well. We'll dig a lot into industries, what industries are important to go long term, what industries, how to correlate your industries, non-correlation, all that kind of stuff. Oh my gosh, I'm not sharing my screen. I went through all that. Thank you, Bagesh, for reminding me. I think this is the second time I've done that. Can you guys see my screen now? Someone shoot me a message and let me know. Okay, perfect. Okay, you didn't miss much. Just the picture of Kanal and I here. All right, there we go. All right, so let's talk a little about what's going to be in the class. August 17th, 18th, and 19th. So Tuesday, Wednesday, Thursday this coming week, and then Tuesday and Thursday of next week, 5 days. So we're going to cover a lot in those 5 days. 8 p.m. Eastern, 5 p.m. Pacific time. And if you join the class and you cannot make these times, totally okay. All of the classes are recorded. And I will probably always do some kind of office hours Q&A that's not in here. And then, of course, if you need to message me, you can message me anytime. If you're watching the videos, don't understand something, just shoot me a message. And I will do an office hours as well, which I always do with all of these classes. So don't worry if you can't attend it live or everyone live. You can always watch the recordings and then contact me as well. And Nick just posted a link to the class in the chat there. Before we get to the topic we're going to talk about, and then we'll talk about some swing trading as well afterwards if you guys have questions about what's going on in the market right now. So, of course, we're going to talk about things like 401ks, IRAs, the type of retirement accounts you should be using, all the differences between those accounts, and then some very good passive and lazy portfolio strategies to use. We're going to talk a lot about fees, performance, compounding strategies, tips and tricks, and all that kind of stuff. So kind of the standard stuff you think about when you think about investing long-term, which I know many of you probably are. And we're going to really dig deep into the woods on that. But then we're also going to hit some other topics related to a little bit of what we do as swing traders and trading options and other things that will help us get better performance over the long run. So we'll talk about earnings, earning strategies for our long-term positions, some ways to kind of game earnings, hedging earnings, because when you're holding long-term, a lot of what we do is swing trading. We say earnings are, if we like a position, earnings are in a week. We're going to be gambling. We don't know if it's going to pop or drop on earnings. We kind of stay out of the way and wait for earnings to be over. Long-term, obviously, you have to be holding through earnings. And earnings can even affect ETFs if there's a big stock that's really weighted in ETFs. So we'll talk about hedging earnings, understanding earnings reports and fundamentals for longer-term positions. That can have the fundamentals can have a big impact in some of your long-term investments. We don't really touch on that much in standard swing trading. We're very focused on technical analysis. And we will talk about some longer-term technical analysis as well, but we will talk about some of that fundamental stuff. And speaking of fundamentals, we'll also dig into stocks you might be picking for your long-term portfolio, or stocks that make up heavy parts of ETFs you might be entering. Key fundamentals to analyzing long-term performance. Of course, earnings per share, revenues, PE, dividend yield, book value, all that kind of stuff, and how that impacts what we're doing. I even use some of that stuff on my, see if I have that up here. I even use some of that stuff. I don't show this that much with the swing trading group because we don't really touch on that. But as you can see on this chart here, when I'm analyzing some charts that are in pullbacks or have been beaten down, I do look at how are their earnings per share. You can see debt to equity ratio here. You can see sales 1 year. And then there's some other stuff I'll throw on here. And I've got some other charts where I do actually especially for position trades or longer than swing type trades, I will pay attention to that kind of stuff. And we'll be talking about that stuff, which I don't usually talk a lot about. Different strategies, position trading strategies and setups. When I say position trades, maybe to stock you're not planning to hold long-term for say 5 or 10 years, but you might have a position trade on for a year or two. And how do we identify good position trades, which can be very good to trade inside a retirement account, a self-directed type. Swing trading strategies, setups for retirement accounts. We'll really dig into market trends and cycles and timing what's going on in the market. Best time to initiate long-term positions and some strategies for that. Best times to exit long-term positions, because even your long-term stuff, very rare that a company is great for 30 years if you're doing individual stocks. So we'll talk about some of that as well. And we are going to hit some long-term option strategies. So I taught an options class a few months ago. We really dug into options, but we didn't really talk about long-term. That was more focused on swing. So we will talk about option strategies to trade out of your IRAs, handling market drawdowns, and hedging retirement positions using options. So, and we'll talk about a few other things too. And I'm sure you guys will have, as we're going through the class, you guys are really active and we'll have some ideas as well. But this is what I'm going to hit over 5 days. And then we'll we will do an office hours after that. So remember, if you can't attend at 8 p.m. Eastern, that's totally fine. If you guys have any questions, let me know here. Okay, HP is saying you never got the recordings for the earnings. I did an earnings class a while back. If you go into your account, the earnings are over there. Shoot me a message. Okay, your nickname says HPO Desktop, but send me a message. Here is my contact information, and I will definitely get back to you on accessing your recording. SinghJD1@AOL.com. Okay, Josh got your contact, so he's going to contact you about that. All right. Okay. Let's talk now about mutual funds versus ETFs. Just to get an idea from you guys, how many of you guys have mutual funds in some type of account? Whether it's some kind of self-directed account or you have someone doing it for you. Cam says lots. Nicholas, yes. So those of you who do, not that mutual funds are necessarily bad, but my preference is definitely to trade or invest. Sorry, not trade. I'm so used to saying trading, but more investments. invest in ETFs, and we'll talk about why here. So mutual funds, what are they? I think most of us know what we are, but pool together money from many different investors, big pool together to invest in different investment vehicles like stocks, bonds, and other assets. They are operated by a portfolio manager who uses investment strategies to attempt to achieve an investment objective. Now, there are passive ones that will track, say, the S&P 500, and there are more actively traded ones. Now, if you're trading one of the more actively or if you're investing in one of the more actively traded mutual funds, the fees are usually pretty high. Maybe for the passive ones, especially the Vanguard ones, you don't have to worry about it. We're not necessarily talking about those. But the fees for the actively traded mutual funds average around 2%, which doesn't seem like a lot. When we think about it, you look at it and you say, 2%, not a big deal. This guy's going to beat the market, and we're going to more than make up for that 2%. Now we're going to go in a second and compound this stuff, and we're going to see how big a deal that 2% is, and the fact that very few mutual funds, especially the actively traded ones, are actually beating the market. If you average the mutual funds, the 10-year average is 7%, which sounds good, but the market has been hitting 11% during that period. So that's really pretty bad. And on top of that, you're paying 2%. So now if you start to compound that over many, many years, that is a huge difference in how much you're going to have for retirement. And we'll see the impact of that in a second here. Now let's talk about ETFs, exchange traded funds, a basket of securities that trades like a stock. Most of them are one of two ways. They either track some kind of index, or it's a basket of stocks that make up a certain industry or a class of stocks. Fees are generally much lower. Now, this is the averages between ETFs and mutual funds. You might find a mutual fund that is cheap. You might find an ETF that is a little more expensive. But in general, the average ETF fee is 0.2%. The ETF fee for SPY, the S&P 500 ETF, is only 0.09%. So really, really small. Performance can mirror an index or a sector. There's no one necessarily managing it. You pretty much know what it's doing. One is something's tracking SPY, you're going to get the performance of SPY. If it's a certain industry, like say semiconductors, you're going to get that performance of the industry. Tons of different ETFs from different indexes, industries, etc. Of course, there are tons of different mutual funds as well. Okay, so a little introduction to what we are talking about. Now, let's go over an example, a comparison of two. A big one here, FAGAX, mutual fund, versus SPY. I picked FAGAX because it has had the exact same performance or pretty close to the same performance as SPY over the last 20 years. So both of them right around 11%. So we're going to assume performance is the same, although many mutual funds will lag the performance. And of course, there's always outliers that will beat the market and beat it handily, but you never really know which one is going to do that. It's a crapshoot, kind of like this book here, Fooled by Randomness. It's pretty random in terms of picking the right mutual funds that are going to beat the market. So let's talk about the fees. That's the big thing with mutual funds. The average sales charge for a mutual fund is 5.75%. Now, there are funds that charge hardly anything, but the average is 5.75%. And when I say sales charge, that essentially means most of them are front loaded. So what that means is right off the bat, whatever you invest, they are taking an average of 5.75 out. So if you invest 10,000, essentially 9,500. If you invest 100,000, 95 right away. And again, that's an average. You can find ones that are cheaper or more expensive, but we're going to take the average, which is 5.75. Then there is an expense ratio, essentially an administrative fee. The average expense ratio is around 2%. We talked about that before. Now, it's actually lower, half that for FAGAX. So for a mutual fund, this is actually a pretty good expense ratio, and it has pretty good performance on 11%. But the expense ratio is 1.06%. So you have that sales charge for FAGAX, which is right off the bat, they're taking 5.75%. Expense ratio 1.06%. Doesn't sound too bad when we look at that, but we're going to see the long-term impact for your retirement account using a good mutual fund like FAGX. Now, let's say you just want to mirror the market, so you're going to take the S&P 500 ETF SPY. SPY also 11% over the average of 11% over the last 20 years. First of all, with ETFs, there is no sales charge. You go in and you invest $25,000, $10,000, whatever it is, that is how much you are investing. Maybe your broker charges a commission. What is it going to be, like $10? Or many brokers are no fee. So, $20, whatever it is, insignificant. So essentially no charge in the beginning. Now let's use an example now and compound this thing, comparing these two with, remember, the exact same performance. So they're both 11% a year. So you would think by the end of 25, 30 years, both of these things should give you the same amount of money. But now you're going to see the impact of 5.75% and 1.06% versus just the expense ratio of 0.09%. So let's say you invest right off the bat $25,000, and then you're adding $10,000 a year. Okay, so essentially over 30 years, you are investing $350,000. Let's see the impact now between the mutual fund and the ETF. So for FAGAX, you invested $25,000 initially. Right off the bat, you are down to $23,562 on entry. Now, factoring in the sales charge and your expense ratio, your end value would be without the fees, 2.7, right around $2.7 million. That's with $350,000. Was that right? $350,000 invested over the life. Your actual end value is going to be around $2.19 million. So that's what you're going to get. Sounds great. 350 to 2.1 million over 30 years. It sounds pretty good, but it cost you $500,000. That's no small chunk of change. 2.1 sounds good, but it sounds pretty bad that the fees, the cost of being in this thing cost you $500,000. So quite a bit. Now let's compare to SPY. First of all, SPY, the entry is $25,000 and it stays at $25,000. Right off the bat, that has saved you over the life with compounding around $25,000. So huge savings just by not having to pay that sales fee. End value, 2.781, that essentially $25,000 more, or maybe I'm wrong about that. It might be a little more than that. End value is more, obviously, because you didn't have that sales fee. And then with fees taken out, it only cost you $53,000 over that 30 year, that 0.09. I got to charge this here. That 0.09 only cost you $53,000 versus $556,000. So essentially you are saving $500,000 by going with the ETF, and that's assuming the same performance. Now, very few ETF, over few of the mutual funds are actually going to perform like SPY. We picked one that did, but most of them are going to lag. We saw that average is 7% versus 11. Maybe you get lucky and get one higher, but the odds are that you won't. So a couple of sales fee alone costs you around $25,000. This is assuming market performance on both of these guys, and then the total contribution from you was $325. So again, 2.1 or 2.2 sounds great, and it's good, but you'd probably want $500,000 more, which the SPY here would do. And again, that's assuming the same market performance. So really good example here of just how much a mutual fund is going to cost you versus the ETF. So if you learn a little about ETFs, and you can passively do this, and we're going to talk in the class about strategies for passively and actively doing. So whatever your mindset is, I just want to passively do it, pick a basket of ETFs that I think will match or even beat the market, and we'll talk about strategies for doing that, is most likely going to be a better way to go than mutual funds. Essentially, you don't need these guys doing this for you. Spend a little bit of time and you'll be able to outperform what they do. Okay, ETF timing, we just talked about passive. You can do it passively. Just add whenever you make contributions, basket of ETFs that you know you want to be in. And what we're going to talk about, how to create a good non-correlated passive type portfolio. And then if you really get into this and you want to more actively do it and really try to beat performance, you can use technical analysis strategies. Let me get my charts up here. We've got SPY. All right. So, and we're really going to dig into this in the class. Mostly today, I wanted to show you the difference between mutual funds and ETFs and how important those fees are and what compounding really does to it long term. But for technical analysis strategies, now we're going to use weeklies, which I never do. Those of you who know me as swing traders know we're usually on the dailies. For what we're talking about now, we're going to be longer term, even weeklies and monthlies. Two main things to think about with regard to technical analysis and the chart patterns when you're investing long term and thinking about when to enter. Now, if you're passive, you might just be, you decide every year you're going to put in 10,000, or every month you're going to put 100, 500, 1,000, whatever it is, and then just keep going into those. That would be more of a passive strategy. More of an active strategy, but would be actually trying to time these things. And we can use essentially two different strategies. One strategy that you can use is waiting for these big ranges to break out. These long-term ranges. When you see, if you look at SPY, you look at the Qs, you pull out the charts here. Let's just look at it here. You can see, for instance, back in 2014 to essentially 2016, SPY was in this huge range here, and then it broke out of the range in 2016. And you can see ever since that, there's a deep pullback here, which we're going to talk about in a second. Huge run from about 200 to 445 since then, after a couple of years of just grinding. So you can use that strategy. The strategy I really like to use is timing your entries based on fear, based on value, say a Buffett type strategy. And as swing traders, we call them rubber band setups when there's fear in the market, fear in a stock, and they get really beaten down. You can see here with SPY, these scary periods always end up being amazing opportunities, especially long term. So what I'm doing is always looking for the big dips. When those big happen, putting in as much as I can during those periods. A couple of things here with swing trade, because I know a lot of you are swing traders who maybe swing trade on yourself or with me, but we're pretty precise with swing trading. With this long-term stuff, you don't have to be precise at all. Over the course of 20 or 30 years, no matter where you're entering, it's very likely, we'll say 90%, 95% chance that after 25 or 30 years, wherever you enter, whatever vehicle you're using will be up, assuming it's SPY, one of the indexes. So, if you can enter here, even if you entered here at 95 versus say 72, much better than entering up here versus at 140. So not as much need for precision, and be careful. Sometimes even when you're passively investing, be careful when the market is very extended. And in the class, we will talk about historically, how extended the market, the spots where you really want to be careful and how to measure that extension. Okay, a few things about ETF timing and impact. And of course, we're going to go much deeper into this in the class, but I want to give you guys a little introduction here. When we're talking about value, the rubber band, fear in the market, when the market is crashing, look at the weeklies. a good spot to add is whenever the market dips to the weekly 50-day moving average, which if you look historically, when we look at our stocks and our swing, when we're swing trading the indexes on the dailies, more short term, we get a lot of touches of the 50-day moving average, and we're always looking for pullbacks. On the weeklies for SPY, the S&P 500 or any of the major indexes, the market is so strong historically that you don't get a ton of dips to the 50-day moving average. So when you do get that, that's a very good period to be adding. So again, different strategies you can be using. You can be passive and just say every year I'm going to add, or every month I'm going to add, or you can be more active and say I'm going to add in these spots I think are good, like when it dips down to the 50-day moving average. Now, what's even more rare is when the market dips below the 200-day moving average. That is, for those of you who don't know, the moving average calculates the average price over the last 200-day, over a time period. So 200-day moving average would be the average price over 200 days. 50-day moving average, the average price over 50 days. Rarely do we go under the 200 moving average, maybe once every few years. And during those times, there is almost always panic and fear in the market. So it can be hard to say, I want to put money in at this point, but those always end up being amazing times to be adding. And let's look at S&P 500. You can do this with any, you can do this with the Qs, you can do this with IWM or any of the indexes here. Here's the, I'm on the monthly. Let's go to the weeklies. I like to use the weeklies better. You can see here, going back to, the 90s here, the blue line is the 50-day moving average. The red line is the 200-day moving average. If we look here at the long-term weekly chart, let's go back to 2008. All right, I got a message, guys, that my connection is unstable. Are you guys still hearing me and seeing me okay? Give me a quick shout out if everything's good. All good? All right, good. So I haven't been breaking up, good. Okay. So if you look here, we've had plenty of tags to the 50-day moving average. Maybe when I say plenty, I mean 2 to 3 times a year. You can see 2012, 1, 2, 3, 2013, not once. 2014, it happened once. 2015, maybe 3 times, and so on. So, anywhere between 1 to 3 times a year. Since the pandemic low here, we haven't hit the weekly 50-day moving average yet. Market is very extended right now. So these end up being good buying spots. Instead of say adding up here, you would add on the dips to use those 50-day moving averages as potential entries. Then now let's look at when do we tag and when do we go below the 200-day moving average. And you can see here the last time was a year and a half ago when we had that scary pandemic crash, right? And it happened very quickly. But you can see we hit the 50-day moving average, then pulled back to the 200, and then actually went below the 200. And here is also where we talk about precision is not really that important. You're rarely going to be able to time it perfectly. But, if you entered here at 266 and, for a short period, you were feeling some pain, but look where it is right now, 445, right? Then we had a tag here in late 2018. This was back in October to December 2018. During that period, this felt even though it doesn't seem very significant compared to what we went through in 2020, when this happened, this was pretty scary back in late 2018. But look, we went right to the 200-day moving average. If you had some extra money to put in your retirement accounts, this was the perfect time to do it. Same here, 2016. So like 2016 to 2019, we didn't have one period, but here we had a spot. Here we had one in 2011. Who knows when our next time will be? Maybe at some point it'll happen. Maybe it'll be this year, maybe it'll be next year, maybe it'll be the year after. But when you see that, if you can, that's a really good spot to be adding. And then of course, whenever we pull back to the 50-day moving average as well. Now that's not to say it won't go lower, but you're getting in at a pretty good spot when it tags the 50-day moving average. Now let's do a real world comparison in how this can save you or make you more in terms of performance. So Let's say you entered February 2018 and you're investing 25,000. So February 2018, S&P 500 hit 280. And that would be right around here somewhere. It actually went higher. It went up to 290, but close to 290. But let's say you got in somewhere here at 280. Okay, so you bought up here. This is a spot where when we think about market timing and the market being extended versus overbought, we want to be trying to time our entries. If you're being active, if you're passive, this stuff doesn't matter. You go on a time frame. But if you're actively doing this, you don't want to be getting in when it's super extended, which it was in 2018. You can see the gap here between the moving average and price action had got extreme, where to a spot it very rarely gets to. Look here, it happened. Here it happened. And what happened in both spots? We got big pullbacks. So if you entered at that point with $25,000, you could get 89 shares at 280. Okay. Now, 10 months later, we got what we were looking for in terms of a tag of the 200-day moving average, the 200-day moving average here. Now, we're assuming here you timed it perfectly, but we know, we've already said, if it hits a 200-day moving average, if we have some money set aside for this, we will enter at that point. So let's say now we use that 200-day moving average strategy. Now we're able to enter at 235. So now with that $25,000, instead of 89 shares, we can get 106 shares. Doesn't seem like a lot. What's the difference between 17 shares, right? But there is a difference. So now in 1998 to 2018, let's say this was 2018, the market the S&P 500 went from 98 to 235. So essentially 140% gain. So now let's assume from 2018 to 2038, we're holding these things long-term. Something like SPY, you're going to be holding long-term. So let's say we get another 140% gain, okay? So let's assume now SPY goes to 561 20 years from 2018. That, not 100 shares, that 89 shares, if my math is wrong, someone correct me, but I think it's right. Yeah, that 89 shares becomes 49,929. Now, if you had 106 shares, remember, it's in SPY. You're investing the same amount, $25,000. One you bought in February, one you bought in December using that timing strategy. Essentially, there's some other factors we'll talk about that go into it, but one of them is tagging the 200-day moving average. So now you can get 106 shares instead of only 89 with your $25,000 in the same trading vehicle. The difference is $10,000, which is essentially around 20% difference in performance over that 20 years. So now imagine if you're investing more, continually timing, you're going to be beating what your performance would have been by a significant amount. So in just this example of $25,000, it's a $10,000 difference. So better market timing creates a $10,000 difference in that $25,000 initial investment. 49, essentially 50 to 60. You'd either have 50,000 or 60,000 based on that timing. Note that your timing will never be perfect, but this illustrates the point. Over time, you're going to be getting in at better spots. Every once in a while, maybe it was extended and gets more extended and a dip doesn't come and you end up missing out on an opportunity. But over time, you do this enough, it's going to make a huge difference in your account. So remember the basic concept here. Invest if you're actively doing this. Again, passive, it doesn't matter. But if you want to be a little more active, and it doesn't take much time to do this, but avoid really overbought levels. And we're going to dig into the woods more about what is overbought and how we should be looking at this. Avoid the really extreme and when I say overbought, I mean extreme. There are certain spots where you just invest. And even if you're passive, you could say, you know what, maybe this month I'm going to wait a little bit because we are super extended right now. And then always remember, even if you're passive, that when the market gets extremely overbought, that's equaling opportunity. And maybe you want to try to invest a little more at that time. Even if you're a passive investor, go off what you normally do a little bit and try to put a little more when the market gets really overbought, like these opportunities, like right here in 2016. Here, in 2018, here in 2020. Okay, guys. So a little introduction of some of the stuff we're going to be going over in the retirement trading bootcamp. Of course, we're going to get into 401ks, IRAs, passive investing strategies, all that kind of stuff. But we will also hit fundamentals, earnings, option strategies, swing, not necessarily swing, but position trading in longer term strategies, trading out of your actively self-directed type accounts, and even some broad swing strategies that might not be as long term if you have an active account that you can trade out of. So the guys at Bulls, they are, I don't handle any of the pricing, but they wanted to give a $200 discount if you join today. Coupon code is earlybird200. I think they're going to lift this tomorrow, we're going to be starting on Tuesday. So regular price $897. It'll cost you $697 now. Again, it's going to be over 5 days. Let me go over the schedule again. Actually, take a screenshot here. It's early bird 200. Let me put it in the chat. Early bird 200. Dan, we are going to go over dividend investing. And actually, even with ETFs, some of the ETFs have decent dividends. And that does make a huge impact in your performance as well. And when you're hitting retirement, it can be good for income too. Yes, we would definitely be hitting that. Not today. That'll be in the class. I just wanted to give you an introduction here in the webinar. So this is what we'll be going over, guys. Early Bird 200, and the link was posted to the Josh or Nick. If you're still here, can you post the link again to the sign up? Now we'll do a Q&A. If you've got a Q&A, if you've got a question about what we talked about today, stuff I'm going to go in over in the class. I'm just going to stick to the class now. But then if you guys want to talk about anything related to just swing trading, and Josh just posted the link again to the trading to the course. And again, remember early bird 200 to get that $200 off. Again, it's going to be 5 days, 3 this week, 2 next week, 8 o'clock Eastern time, 5 Pacific. And then again, I'll do an office hours where we get together and mentorship, and you guys can ask me questions. And if you missed any of the classes, you don't have to attend live. There'll be recordings. So if you want more, go ahead and join. And then, of course, you guys know I'm on Bulls on Wall Street, Twitter, Instagram. Follow me there. A lot of valuable free content as well. If you guys want to talk a little bit about swing trading, you can see where the market is right now. For a swing trader, it's actually a little bit extended at this point. And August, historically, tends to be a choppy, weak month. We're getting out of earnings season. We do have a number of interesting stocks that have had earnings, both breakouts. You can see these two lists here, earnings breakouts and breakdowns, that are putting in some decent setups. You can see here DDOG, earnings breakout pullback to the 90 MA, and now is hitting highs. This one is really interesting. AMD, which has been one of my favorite stocks right now, favorite bigger stocks, big tech type stocks. This is one I actually like long term as well. If we're talking about retirement, you're not just doing ETFs, but a basket of stocks as well. Love AMD, and AMD has broke out of a year-long range, so could be ready for a big run here. Had fantastic earnings. You can see this was its earnings date, so it's sitting around 94, hit all the way up to 122, got extended, but now has pulled back and is holding its key support level here. So I like AMD a lot. And there's some other here earnings related plays that are looking really good. And there's actually some interesting breakdowns. One of my favorites is Bank of America. Another one that's maybe decent if you're looking for financials for long term, but actually had very poor earnings reaction, went down 5%. But I love stocks that have poor earnings and then reverse, which is what BAC has done. And you can see we talked about 50-day moving averages on the weekly for our longer term, but it remounted on the shorter term for swing on the dailies. It remounted its 50-day moving average and is about to test highs as well. Sophia, yeah, UPST. You can see here, very strong here. Low float, a lot of volume coming in. I haven't looked at the short interest, but I have a feeling there's plenty of short interest here, so there might be a little bit of a short squeeze as well. And this was an IPO from 2020. And when it pops, it tends to make really nice moves. The other interesting thing about this is every time it pops, at some point it pulls back hard and gives you good short opportunity as well. All right, guys. Really class. Great session with you guys. Again, if you want to join the class, Early Bird 200, and the link has been posted here in the chat. Maybe Josh, one more time. So join me on Tuesday. If not, shoot me a message. I try to get back to everyone. And of course, you find me on Bulls on Wall Street, my own site, Paul J. Singh, Twitter, Instagram. If you're a swing trade service member for swing trading, join me in the chat room, get active there as well. All right, guys, this was great. I can't wait to see you guys in any other capacity. Also, the weekly swing report, which is free, comes out on the weekends. And I'll see you guys in the next coffee and stocks with Paul as well. Jim, there's no PDF. There probably will be a video released. So check Bulls on Wall Street YouTube. Usually the video is posted there. So just go to YouTube, Google Bulls on Wall Street. And while you don't have access to the slides, you can rewatch this. So essentially you do have access. You could, look at the slides there. Okay. All right. Okay, guys, this was fantastic. I will see you soon in some capacity. Thank you. Bye-bye.